Hello, investors and traders. Welcome to Scientific Investing. I think we are an important juncture of market, and after 1.5 years to 2 years, we are seeing some kind of correction in the market. So there is a question what will happen, where market will go from here, what to expect. So I thought I'll put some perspectives. And last time we released a video on overall market that was in the month of May when we spoke about small cap. We also spoke about some of the PSU stocks. So let us see quickly what did we highlight in those months regarding what could happen in the market, how to manage the asset, what to do. Standard disclaimers, nothing is a buy or sell recommendation. I just share my perspectives. So please do not consider as any kind of stock tips. If you are here for stock tips, this is not the platform. If we look at this data is return analysis of various indices. And we see most of the indices, the 10 and 20-year return CAGR has been around 15 to 16%. And that is the normal expectation. And the last 4 years of outperformance has contributed to it. Else it was around 12 to 15%. But when you look at the small cap, look at the 5-year CAGR and 3-year CAGR. These numbers are around 19% and 29%. And reversion to mean is a very, very powerful concept. So if the long-term return has to be around 15, 16%, this number might come down to some price correction or time correction. So this again highlights, if you look at this data and what we are looking in terms of results, where Nifty, as I said, might be in fair value zone. The Nifty returns are almost similar to the long-term return, maybe 1 or 2 BPS, 100, 200 BPS higher. But small cap does look uncomfortable. And what is interesting is being totally ignored by the market. Nifty banks, where the last 5 and 3 year of returns may not be highly depressed, but relatively on the fairer side, maybe because of the underperformance of the Kotak Bank and the HDFC banks and all. So this is another way to look at data. And again, the idea is to triangulate it through multiple sources. And slowly this number is only coming down, which says the breadth of the market is weak. Even though the index is being maintained by fewer and fewer companies, but the broader participation of the market is missing. And right now we are almost into tie situation where we have 53% of the companies above 50-day moving average, 47% of the companies below 50-day moving average, which is like a head-to-head situation. So all of this highlights the concerns which are there on the small cap index and below. So usually what we do in such a situation, so I can just share how I manage this situation. I manage this situation more at an asset allocation level, more at a tactical level. So if you remember 2-3 months back, I think somewhere in April, we had made a video on gold. So I try to have, and it's not like what I'm doing right now. I have already done this in last 2-3 months when these kind of, challenges were visible. So a little bit in gold, little bit in silver, but only when it was, the asset class looked right. I will try to, being a small cap investor, I will try to diversify a little bit. So rather than being 100% in small cap, I will reduce my allocation from small cap. I will have some large caps. Maybe the returns might not be great, but one of the priority becomes to manage the volatility in the portfolio. So that is how I try to balance it out. Also, in bull market, we try to get into different kind of stocks and we don't have the same level of conviction in all the stocks. And worst of the mistakes happen in best of the markets. So these are times when I keep having a relook at portfolio, finding where I don't have conviction, what is not doing well, where there is a valuation froth. Am I in this stock really for 4-5 years, or I am just playing a 1-year game? If I'm playing a 1-year game, I have to be very, very serious about the momentum of the stock, the results, and then try to get rid of all the weaker stock, weaker by conviction, weaker by action, and stay there where I have very, very strong conviction. So these are some of the things I do to manage in these kind of situations. So since then, we had caution related to the valuation gap. Market has corrected. It did go up and then it came down. It went up, and now from the year beginning, in terms of drawdown, I think most of the indices are 10% down, and still the market is up maybe 3 to 5% up, gone nowhere right now. And that time we had discussed the Q4 results, then Q1 has happened and Q2 has happened. So almost 2 quarters have passed. So the question is where we are. Now, when we look at the data, especially the Q2 data, Nifty has grown its sales. The whole Nifty 50 has grown its sales somewhere around 9%. The Nifty Next 50 on a year-on-year basis around 11%, and mid cap and small cap around somewhere around 11-12%. Overall, when we take all these 500 stocks, the sales growth rate has been around 10%. That is how the market was growing. But when we look at the PAT growth rate, the PAT growth rate has been in mid-single digit around 5-6%. So from 3 quarters back, where the PAT growth rate was double than the sales growth rate with more than 20% plus PAT growth rate, we have come to a situation in 3 quarters where now the PAT growth rate is almost half of the sales growth rate, or maybe in the single digit. And one important announcement. So we are having a 2-day workshop in 3 cities, Delhi, Bangalore, and Mumbai. It's a Techno-Funda workshop where we will cover right from the scratch to advance in terms of fundamental, technical, how to generate ideas at systematic level, how to track those ideas, how to do research, blending fundamental and technical, how to take position, how to do allocation, how to look at a portfolio, how to look portfolio management, how to decide on sell, how to manage different kind of market condition, along with a very systematic driven approach. Not only that, one will get a lot of other goodies in terms of 3 months of practitioner subscription, 3 months of Simba access, and a lot of other things. Bangalore and Mumbai, which is there, Bangalore is next week, Mumbai is on 14th of December. Both of these are almost 75-80% filled. The last 20% slots are remaining, and Delhi will be in February, so we have time to go. So in case you find it interesting, do register. All the details are there in the description. You can explore more in those links, and then you can decide. Why has it happened? I think the margin top out concerns which we had highlighted, that is playing out. So again, when we take the consolidated margin of this Nifty 500 basket, in Q2 FY24, we were at around 10.8% margin. And this quarter, we ended up around 10.2% margin. And the valuations, as we had highlighted on small cap, we had gone at around 34-35p kind of valuation. The same market, if you look technically, because we have discussed about valuation, we have discussed about EPS growth rate, we have discussed about fundamentals. So if you look at first the Nifty 500, when you look technically, this is a weekly chart. And when you look at the weekly chart, the March 2023 bottom, and we went into a bull market with an uptrend with your, a 13-week exponential moving average being above the 20-week closing price, above which, and at a weekly level, except this one, most of the times the 13 or 20-week moving average was respected. This is for the first time we are seeing the first support level. This support level, which was a weekly support level, which got created during July. This support level market came down. It tried to find support near this level for almost 3 times. 3 times in a week, this level acted as a support. And then 4th week, it has broken. It is trying to go up, but still it is not reached here. So in terms of technically the market direction, I think this level is crucial. Ideally, this level might act as a resistance now. And if acting resistance, the market is not able to cross this level, again going down, this will be another further negative signal. There is no point in predicting how it will pan out, whether it will go sideways again 1 year. But let's see. But this is where we are technically. This is not a good sign technically, the breaking of this. And another confirmation we will get when it tries to breach it, and we need to see whether it is succeeding or failing. When you look at the small cap index, something similar which is happening, and you can see there were repeated attempts to break out, failed, looking like in terms of a head and shoulder creation. If you look around these levels repeatedly, these levels have been trying to act as a support, and looks like it is getting broken, and I mean, almost on the borderline. But the good thing is quickly somewhere here, you have your first support here. So in terms of action now, my future action point is to look if I have to invest further and use some cash, whatever I'm having. Whether this will create a bottom or whether this will create a bottom, what we will see, again, time will tell. Nobody knows. As I said, we live in probabilities, and for me, it's not only about technicals. It has to be supported by fundamental, it has to be supported by liquidity and a lot of things, and then taken a call at a probabilistic level. So far, things not looking that good. Now, what has happened with this 10% drawdown and result, and what to expect going forward? So let me put my perspective again. Please note, it's a very, very important point. Markets are dynamic, and we all think in terms of price correction. Whenever we will talk, or kitna girega, or kitna badhega. And most of the times, these discussions are in terms of price correction. But there are three things which move parallelly. There is a price correction which moves parallelly. There is a EPS growth which moves parallelly. And the combined effect of price and EPS growth reflects in valuation which moves parallelly, and time also flows parallelly. So basically, when market undergoes a correction, there is a price correction, there is a time correction, and there is a EPS growth based correction. Now, let us see where we are and where we could be logically. So if you look at the small cap index, and this is a beautiful feature on screener where you can go and you can type, small cap index, and you'll get the data for small cap index, and you can visualize the PE, look at history and all of that. Now, as we had highlighted at that time, we were around 36 PE, and with this 10% correction, we are hovering around 32.8 PE right now. Now, historically, if we see, usually if we are a growing nation, the market is growing at 12 to 15% kind of EPS. A 22 kind of P is always possible. Many bears, they always kind of like to have a 15 P. Some like to have a 16, 17 P. Unfortunately, those kind of markets in terms of distribution of time, like let's say if we take last 25 years of data, 25 years of data means 25 into 12, which is almost 250, and 300 months of data. Out of 300 months of data, the market would have traded below 16p in maybe 10% of the times. So are we going to wait for 1 month out of every year, or maybe 3 months out of every 3 years? No, ideally that is not how it happens. And same way at 28, 27 PE also is not sustainable until the market is growing at that rate. But most of the times market spends more and more between this 19 to 20 to 23 kind of band. Maybe I will present a separate analysis on the distribution analysis of this. But the point is, if we are growing in a decent manner, decent double digit, expect 22 PE kind of thing to sustain, and 19 PE kind of thing becomes attractive. So currently we are still at 32 PE. So the question is how we can come down from 32 PE to a 22 PE. Again, the market can go up in between also. Nobody knows. We are just trying to make data-driven extrapolation and then blend it with charts and see where we are and how we are. Now, let us say, I'll put another data point. When you look at historic corrections, the small cap index goes through a 25% correction at least once in 2 years. If we look at the total count of more than 25% corrections which have happened in last 20, 25 years. And in last 2 years, we didn't have, after we corrected in March, I think March we went through a 25-30% correction in March 2023. We haven't seen it. And we are already 10-11% down. I don't want to predict what will happen. I'm just presenting all the views depending on data. But let us say we don't correct 25%. Let us say we correct 20%, which means we'll correct 10% more from here. So this 32 PE, which is there, it will come down 10% further. That means we'll go below 29p. Let us say in this time, the market EPS growth rate will happen. Some growth rate will happen. If EPS growth starts going down, then I think we are in real mess. But let's say EPS grows at 10-15%. Again, that 10-15% EPS growth rate will bring down the valuation further. So maybe from 29, we will come down to maybe somewhere around 25. That is how I'm looking at this market. So if next 1 year market doesn't go anywhere with maybe a 10% correction, which means we will have almost a 1 year, 3, 4 months kind of correction, we will come down to around 25. But then again, depends what is the constituent of index, what will move out, what will come in and all. This is how we have to look at this data. So still, I don't see this is a market where things have become very, very attractive. And again, it's a generalization. The good part is when the market is at 35p, the chances of getting very attractive bets becomes lesser. But when market comes down to 30, you have better chances of finding good performing stocks at fair valuation. When the market further comes down at 25, your ability to identify winners further increases. When markets comes down around 19-20, even if one invests in index, he makes decent amount of return. When market comes down around 16-17 PE, you invest in index and still maybe a 20% kind of return will be possible. So it's all probability, and I'm just trying to highlight. I mean, I try to still find winners despite of that. 2 weeks back, we had a session on FMCG. We keep trying to identify if there are any good performing companies available at fair valuation. But yeah, the task becomes difficult the more overvalued the broader market is. The task becomes difficult the more the broader market is in negative direction, because the stock has to flow against the market to make money. So mota broadly, that is how I see this market going. Next 1 year, some price correction, some time correction. Even if the market goes up, the chance to have a sustainable move looks difficult until and unless the earnings growth rate comes back to 15%. Because the moment you go 10% up from where you are back to 35p and you are giving me a 6% EPS return, so how it is logical? So all the non-logical things can play out for short term, 6 months, 8 months, and I think that is what has been happening since last December, January. But slowly looked like market started catching up with valuation with the Q2 earnings growth rate, which got reflected in this correction. So I'll not be in lot of hurry to buy things from a value perspective, but I will keep trying to find some good potential winner stocks. And if those bets work, I'll keep trying to deploy some money. This is only regarding small cap. So if you look at Nifty PE, the Nifty PE is down from 24 to 21. This is the 1 year of data, 10 years of data. And if you see 20s, see how much time market has spent around this zone. So I believe Nifty is in fair range. There is nothing to worry. And this is why, again, I'll go back to the last video which I made. Asset allocation becomes more important in these markets. So let me give you another data, because all these indices doesn't reflect the pain. 55% of the stocks have corrected by more than 20% from their top. And 33% stocks have corrected more than 30% from their top. That tells the pain in the market from top. Of course, everybody has made money. People who have been kept on investing in last 3-4 years, we all have been sitting on gains. But I'm talking about those who have put money in last 3, 4, 5 months, more money. What kind of pain is there? But still in Nifty, I don't see that kind of growth. And if Nifty can grow at 10%, I think it's a decent fair value zone. So let's see how it goes, where it goes. But the idea is to still believe in asset allocation. I think any extreme is dangerous. Always have a balanced view. And with these kind of simple data-driven approaches and having a balanced asset allocation view by going little more in cash, by being fully invested when market is very attractive, one can manage these kind of things. And then that is how the beauty of investing, you will be able to extract the best out of it rather than this whole 1 day cash and 1 day fully invested. I hope you like this video, but apart from YouTube, we also keep generating a lot of content in terms of newsletters, in terms of blogs. So we will be coming up with another newsletter this weekend tomorrow. If interested, you can go and register for the newsletter on scientificinvesting.in or access those newsletters or access those blogs through scientificinvesting.in. All the resources, free or paid, whatever we have put it there at scientificinvesting.in. So don't forget to explore. So if you like this video, do like it, do subscribe, do circulate it among your friends. That is how content gets recognition. And I'll see you in the next video soon. Thank you.